NIADA has asked me to talk about financial statements, and they've asked me to keep it fairly high level, particularly for people just getting into the business. So we will talk about financial statements and then what lenders look for, what dealers look for, and what accountants look for in financial statements. So first thing we need to talk about is GAAP versus tax. There's an old joke in the mob movies that everyone has two sets of books. Well, in real life, there are two sets of books. Every one of your companies has two sets of books. It depends which set of rules you follow. There is GAAP basis and there is tax basis. Most small dealers follow tax basis, and that is because tax basis is how you file your income taxes. And so a small dealer, his primary concern is just how much taxes he will owe at the end of the year, so he prepares his books using tax basis. Larger dealers are required to follow GAAP basis, normally by their bank. Your bank will specify that your financial statements must be prepared using GAAP. GAAP is a more conservative accounting approach and usually results in a less net income and smaller assets, and that is why banks want you to use a more conservative measure when measuring your financial statements. No surprise, tax is a more aggressive accounting approach because the IRS wants you to show more net income to pay higher taxes. So most small dealers follow income tax basis, mid to large dealers follow GAAP basis. But everyone technically has both sets of books. You just never look at the other one because you look at one that makes the most sense to you. Biggest differences between GAAP and tax is that GAAP requires your receivables have a reserve for future losses. Under tax basis, you may not have a reserve for future losses because the IRS doesn't want you to deduct something until it really goes bad. GAAP is more conservative and wants you to put something aside for your future losses. That is the single largest difference between GAAP and tax basis. Now we also need to talk about types of financial statements. There are audited financial statements. Most dealers who start to borrow $10+ million will likely need to be audited. Audited financial statements are obviously the most expensive, but they're also, in theory, the most reliable since the accountants have put in the most time verifying the information. Reviewed financial statements are normally required when you start to lend between $2 to $10 million. And reviewed financial statements on their face are very similar to audited financial statements. It's just that the accountant doesn't have to do the same level of verification on the numbers as an audit, but the report is almost identical. So that's your mid-sized dealers are going to have reviewed financial statements. Compiled financial statements are the lowest level that an accountant can prepare. Your small dealers will normally get compiled financial statements, and in a compiled financial statement, the accountant is not required to verify any of the information he receives. If you say your inventory is $1 million, he will put $1 million on your books with no questions asked. That is why larger, once you start to borrow real money, banks generally require more than just compiled financial statements because they want the accountant to do a little bit of work verifying the numbers. Just to help put things in perspective, compiled financial statements for a small dealer will probably cost you a couple $1,000. Reviewed financial statements, $8,000 to $10,000. Audited financial statements, $20,000+. Combined financial statements. Many of you will have a related finance company. We highly recommend you only produce combined financial statements to show your lenders. The reason is the individual financial statements of the dealer and the finance company have been intentionally manipulated to produce a better tax answer. Well, in producing a better tax answer, we are intentionally deferring revenue, and those financial statements will not necessarily show a complete picture of your dealership because we are doing things to defer revenue to produce a better tax answer. Combined financial statements are where you take the dealership and the finance company, and you join them back together into one big company, and you eliminate the selling of notes between your dealership and your finance company. You unwind the sale of the notes effectively and show the combined operations of your dealership. Most banks will require combined financial statements because it does show a better picture of your complete operation versus looking at each individual company by itself. That's just an illustration of how the combined works. Combining the two companies, again, you simply do not add company A plus company B. Because we sold the loans between the companies, you have to add the companies and then unwind the sale of the notes. There's an extra step that many people don't do, and you have to unwind the sale of the notes in order to get a true picture of the combined financial statements. Comparative financial statements. Comparative financial statements are simply financial statements where you compare your current results against prior results or another dealer or benchmark. It's simply a financial statement that compares your results against other financial statements. Great for dealers. I have many dealers who want to see how we're doing August this year versus August last year, year-to-date this year versus year-to-date last year. It's very good to manage your business just to see how you're doing, and also helpful if you can line your numbers up against benchmarks. Just an example of comparative financial statements, August 2013 against August 2012, and what sort of change we had. You can see sales are up 10%, but our cost of sales are up 25%, meaning we've actually lost gross profit. Bad debts are also up 18%, so probably not a great year. When we talk about financial statements, there are actually 3 sub-financial statements that make up a true set of financial statements. The balance sheet, which is a list of your assets, liabilities, and your owner's equity. Your income statement, which is your revenue, your expenses, and your net income. And then a cash flow statement. A cash flow statement is a breakdown of where your cash for the year was spent. The cash flow statement is often optional and is normally not included in lower level financial statements. Normally only audits and reviews include a cash flow statement. As I said, the balance sheet is a list of your assets, your liabilities, and your equity. Ironically, when I talk to dealers, they often go straight to the income statement, also known as the P&L, and they want to talk about their revenue and their cost of sales and their bad debt. As accountants, I go straight to the balance sheet. I look at the P&L last. The P&L tells you how you got to where you are. The balance sheet tells me where we've ended up. The balance sheet tells me what my assets are, what my debt level is, and how much equity the owner really has in his business. To me, that's more important than what we sold and how much our bad debts were. The bottom line is, how much equity have we built in the business, and how much debt do we have, and how levered are we? So accountants go straight to the balance sheet, where operators tend to go to the income statement first. Banks also use the balance sheet the most. Most of your covenant ratios will be based on balance sheet items. There are only a handful of covenants that are based on the income statement. Here is a balance sheet. As I said, it is a list of your assets and your liabilities and your equity. You start with your current assets, that's your cash, your accounts receivable, inventory, everything that's expected to be collected within 1 year. Then you have your long-term assets, which is generally your fixed assets. These are long life items like your land, buildings, equipment. That's your total assets. You start with your liabilities, and it goes in order of liquidation. So your most current stuff is first, with your longest term stuff last. So you start with your accounts payable, your sales tax, your credit card, that's first. And then your lines of credit and your floor plans are down are the bottom liabilities, because they are longer term items. And then the bottom section is your equity. Equity is how much money the owner has in the business, but not just what he put in originally, how much he has accumulated. And that is a very important item, particularly for banks, because it also effectively drives your debt to asset ratio. Because assets equals owner's equity plus liabilities, if you have a lot of equity, it means you have less debt to your asset ratio. They go hand in hand. So more equity means you have less debt compared to your assets. Income statement, like I said, it's the list of your income and your expenses. It shows your gross profit and it ultimately shows your net income. It also, your direct expenses are listed first. That's why you have your cost of sales and your bad debt are the first expenses listed. Those are directly driven by your level of sales, followed by your operating expenses, which are known as indirect expenses, the bills that you have to pay every month regardless of whether you sell 1 car or 50 cars. Here it is. It's probably a bit small for many of you. Starts with your sales and your, since we are buyer payer dealers, we also include our finance income as one of our revenues since we charge interest and collect interest. Then we have our cost of sales, which is made up of the cost of the vehicles, the reconditioning, and because we finance customers, our bad debt as well. All of those are what we call the direct expenses. Then it moves to your, and then you'll actually get a gross profit, shows you what you're grossing per deal. Moves to your operating expenses. These are your indirect expenses, advertising, rent, salaries, bills you're going to pay regardless of how many cars you sell. Those are your indirect expenses, which will get you a net operating income, less your interest expense will get you your final net income. Cash flow statement. You should know that the cash flow statement is actually not that much use to a buyer payer dealer. And I get calls all the time from dealers saying, hey, I want a cash flow statement. I want to see where my cash is going. Well, the cash flow statement was originally designed for businesses that don't finance people. It's intended much more for your cash type businesses that sell something, collect the money, and don't really provide financing. Particularly, there are 2 kinds of cash flow statements, a direct and an indirect, and almost all accountants have moved to an indirect cash flow statement, which, as a buyer payer dealer, will not be of that much use to you. The reason is the way the cash flow statement works, it assumes that any change in your assets or liabilities must have come from cash. Well, we finance customers. When our receivables go up, that doesn't mean we put that much money on the street. So a cash flow statement for your particular business is not that useful. There are some sections that are very useful. It does have a debt section and does show you how much debt you've borrowed and where you acquired your cash from. But as far as the receivables go, it's a little lacking in that area for your business. Here is the cash flow statement. It starts with your net income because it assumes that your net income is cash, which in this business, that is not a good assumption. Then it minuses your non-cash expenses, such as depreciation. Obviously, depreciation, it doesn't cost you cash, so it gets rid of that. And then it starts to say, well, where did we use the cash? We use the cash to grow the receivables, to buy more inventory, to buy fixed assets, and it tells you how much cash came from your operating activities. Then it tells you how much cash you spent buying fixed assets. And then finally it says, well, where did we get all this cash from? And it lists borrowings on your debt as a source of cash. You borrowed on your debt to fund your activity. Contributions from the owner, more money put in by the owner. And then if the owner took any distributions, well, that's cash he sucked back out, so that's a minus. And ultimately, it actually balances with the money left in your bank account. Trying to show you, how much cash you generated, how much you spent, and how much you left in the bank account. Like I said, although it does balance and it's mathematically correct, it is not that much use to you because it works on the assumption that any change in your assets must have been because of cash, and because of our financing, our receivables change not because of cash, but because we extended credit. We need to talk about how to quickly read a balance sheet. As I said, there are 2 sets of books for every company, GAAP and tax, and I've actually laid the same company next to each other, one under GAAP basis and one under tax basis. The same company under tax basis is actually worth about $7 million in assets. Under GAAP basis, it's worth $6 million, even though this is the exact same company with the exact same assets. The reason is GAAP basis is more conservative and requires us to put $1 million aside for future potential losses, where under tax basis, you are not allowed to put any money aside for future losses because the IRS wants you to pay all your taxes now, and they'll let you get a bad debt expense later when it goes bad, but Right now, the IRS doesn't want to hear about your future losses. They only care about how much you currently have. So even though it's the same company, they have two very different assets and two very different equities. That's why it's important when you're talking to other dealers or you're talking to banks, you need to know what sort of financial statement they are referencing. And I just noticed I somehow snipped the thing with the page 1 right in the middle of that. That's horrible. Anyways, like I said, same company, two very different results based on the basis. Again, larger banks are going to expect you to only talk GAAP basis, the more conservative method, where smaller companies with a smaller line of credit can probably get away with income tax basis. But as an owner, don't fool yourself if you get income tax basis financial statements. Your receivables are not worth $4 million if something happens to you. They are worth 75 cents on the dollar in liquidation. That is the reason GAAP makes you put a little something aside in case you had to do an emergency liquidation. Income statements, like I said, starts with your revenues, in sales and financing income, total revenues. Very good practice to turn everything as a percentage of revenue. That is how the benchmarks are published, and that is how accountants like to read financial statements. There's no good saying that my payroll was $100,000 last year and it's $200,000 this year. I need to know, well, did you double sales? Then, as a percentage of revenue, your payroll's exactly the same. So if you turn everything as a percentage of sales, and then you compare your expenses in percent, it allows you to put things in perspective rather than say, oh, my payroll went up 100,000. Well, you doubled your business, you doubled your employees. It's okay as long as everything stays in line. So you can see we've put percentages here, and I will, at the end, I do have the actual benchmarks we will go through in percentages on what these things should look like under benchmark. You can see here the vehicles are running at 65% of sales. These are actual financial statements for a very successful dealer. So, he's marking up the car 35%, if you look at it that way. His loss on repossessions is at $600,000, but it's only 6%. You should know benchmark is 29%. That is benchmark. 29% of sales is bad debt. This dealer is a long-time dealer with a mature portfolio, and he sells higher-end vehicles. He really does have a 6% loss rate. Well, that's not his loss rate. His bad debt is 6% of sales. But you should know benchmark is 29%. That gets you down to your gross profit. He has 17% gross profit going into his operating expenses. And here we hit his operating expenses. His operating expenses are 12%. Benchmark is 20%. So this is a single lot operator, and he does a lot of the work himself. And so he's able to control those expenses. Once you start adding 2-3 locations and you have managers at every location, your operating expenses will balloon. And so one of the quickest ways to go out of business is to grow too quickly. We've seen many a client go out of business by growing too quickly. The one item I want to point out in his operating expenses, there's payroll. Payroll in benchmark is 10% of revenue. That is benchmark, and it has been consistent over many years. So if you sell 10 million, you will likely need to spend $1 million in payroll. Again, this is a single lot operator where he does a lot of the sales himself. He has just a few employees, and he manages to keep his payroll pretty low. Anyways, that gets you through to your operating income, and then there's interest expense. Interest expense is his interest expense is 3% of revenue. That is benchmark. Benchmark is 3% of revenue. But he has a traditional bank loan paying about 6% in interest. If you borrow from one of the higher risk lenders and you're paying 15% interest, obviously your bottom line will be impacted, and you will have to make up that profit elsewhere in the financial statements. Because when it's all said and done, he only has 1% net income. And so if he had paid 7 or 8% in interest, there would be no net income left here. And like I said, I'll go through what actual benchmarks for all these items are, but every item needs to be watched and controlled because the margins are fairly low in this business. Cash flow statement. Although cash flow statement does show some interesting things, particularly on how much you borrowed on your debt, how much money you put into the business, how much you pulled out of the business. The receivables, again, it says that we spent $12 million in cash growing the receivables. We do not spend $12 million to grow the receivables $12 million. We spend maybe $8 million to grow the receivables $12 million. But a cash flow, mathematically, that's how it works to balance the financial statements. So although cash flow has its place, it is not the be-all and end-all of the financial statements. Yes, sir?
Can I consider an analog of the cash flow statement that's, I don't know, call it the currency flow statement that includes all kinds of monetary?
Sure. So we actually, when clients ask for this, and I think this is not going to give them what they want, I give them a template called cash in, cash out. Real simple, 2 columns. There are only 3 sources of cash in: collections, down payments, and the ACV you recover on repossessions. That is effectively a source of cash. Those are your only 3 incoming sources of cash, not counting what you're going to have to borrow. That's what you're going to get from customers. And then your cash expenses are the cost of the vehicles, reconditioning, all your operating expenses, your interest. And the difference between those is what you will have to borrow. And ideally, eventually, you get to break even where the cash coming in, when you get a mature portfolio, after about 3 years in a mature portfolio, you should be break even on cash and no longer have to borrow and turn into repay mode. But yeah, it's much easier just to, like I said, that cash in, cash out, keep it simple. It answers the question more times than this does. Talk about equity for a second. One of the most important things that banks look at, and it's broken into multiple items. Your common stock, and there's another item called additional paid-in capital. This is the money you originally put into the business to start the business. Can go up, but normally I would say most dealers, when they put additional money into the business, tend to put it in the form of shareholder loans rather than capital. The reason is it's easier to take the money back out if it's a loan than if it is capital. And if you're a C Corp, when you take your money back out, it'll actually be taxed. Most people put in their initial money, and then any additional money they actually put in as loans. So your common stock and your APEC is normally your startup money that you put into the business to begin with. Retained earnings. This is very important. This is how much profit you have left in the business over the years. Every year that you make net income and you don't take it out, it rolls into retained earnings. That's how you grow equity in a business, is by rolling your retained earnings and not sucking out every dollar that it makes. Distributions is you taking the money out. Ideally, if the business makes a certain amount of money, ideally you take maybe a third out of it to cover the income taxes, and you try and leave the remainder to fund operations and grow the business, understanding that eventually you'll cash out at a later stage. Banks don't want to see you pulling out all the money you're making. They don't want to be the one left on the hook at the end. They want to see you reinvesting the money and using your money rather than their money. So it's important that and many banks have covenants limiting your distributions so that you don't suck out all the net income. So that is your distributions. It's what you took out for the year, mainly to pay income taxes. Followed by your net income, that's how much money the company made this year, and that's going to roll back up into retained earnings. You can see right here, we actually have negative equity. Technically, this company is insolvent. And obviously, a bank this would likely trigger covenants. And obviously, you can see what's happened is we've pulled way too much in distributions. And this happens every now and then. Someone needs to buy a house or something like that, and they pull back out a large chunk. This particular case, they've overdrawn and have actually turned the company technically insolvent. Here are the benchmarks. The way the benchmarks work is we have about a dozen very large successful operators that have been our clients for about 20 years, and we've tracked them for nearly 20 years, the same dealers, and we lay their numbers every year against them, and we see how they are doing. These have been published by NIADA and before NIADA, NABD now for nearly 20 years. And they are on our website, the detailed ones with the NIADA 20 group benchmarks as well. But basically, our average dealers spend 61% on the car compared to the sales price. So if the sales price is $10,000, they're in it for $6,100. Bad debt runs 29% of sales. For benchmarks, we define the revenue that this is calculated is purely the sales number, not the interest, purely sales. So for every car you sell, if it's a $10,000 car that you're selling, $2,900 will ultimately not collect. Okay, that is a huge number to overcome when your initial gross profit was only 39%. Already 29% of it is dedicated to bad debts. The thing is, luckily we have the interest. Without the interest, these numbers do not work. Financing income is 20% of sales, so we get back 20% of the sales we get additionally in the form of interest to help offset that bad debts. When we first started doing this, bad debts and interest used to cancel each other out exactly. Unfortunately, over time, we haven't raised our interest rates, but bad debt has continued to creep, particularly since subprime has been buying so deep, we've been forced to pick worse customers. Bad debts have crept up almost every year for 10 years straight. We're now at 29% of sales, bad debt expense. Operating expenses are, as I told you, around 20% of sales. So if you sell a $10,000 car, you're probably going to spend $2,000 just in fixed expenses. This is your advertising, your payroll, your telephone, your utilities. $2,000 of that is already spent in fixed expenses, with half of it being payroll. Payroll benchmark was 10% of sales last year. Interest expense is 3% of sales, and the final net income of the benchmark companies was 7% that they made. Okay, so if they had 10 million in sales, they took home about $700,000, and these are really good established operators with mature portfolios. So the margins, that's good net income, but that's relatively small margins. And if any one of those numbers move just a few percentage points, the numbers the numbers won't make sense anymore. If anything moves on you a few percentage points, there won't be much left over. I want to talk about covenants for a quick second. Almost all of you will have to borrow money at some point, and you'll be subject to financial covenants from your bank. And I want to mention a few things about covenants. Covenants, your covenants and somebody else who borrows from the same bank are probably different. The covenants themselves are arbitrary numbers. They do not mean anything in particular. You might have a 3-to-1 covenant. The same guy borrowed from the same bank might have a 2-to-1 covenant. The way covenants are set is when you sign up with the bank, the bank sets covenants based on where you currently are. And then they hope that you'll just get better and better from that point. They set a baseline based on where you are coming into the loan. Covenants are nothing more than a talking point for the bank. Breaking covenant is not the end of the world. Our clients break covenants all the time. As long as you are mature and you talk to your banker with a plan about what has happened, explain what has happened and what the plan is to rectify it, 99% of the time the banker waives it, gives you time to fix things and get back on track. The covenants are set simply so that when you break it, it's time for the bank to have a conversation with you. They really do not look that hard at your financial statements. They really don't. We've turned in financial statements and we get a call a year later like, hey, I don't think I ever got those. But your covenants are there so that they don't have to read the financials, but if you hit a covenant, they sure as heck are going to read the financials and they're going to expect a call from you as to what happened and what the plan is to rectify. Maybe charge-offs got off, maybe you needed to do a big cleanup. As long as you have a plan, explain it, and how you're going to rectify it going forward, very likely the bank will pass on the waiver, will provide you a waiver on your covenants, and you'll be back on track. It is not the end of the world. I have dealers who play games trying not to break covenant. They hold off on charge-offs. They do some things they shouldn't, and all that does is eventually blow up in your face. Now you have 20% over 90 days because you've been holding off on charge-offs and you have to do a $2 million cleanup, and eventually you have to go to the bank and tell them what's going on. Don't play games, just be honest. Come up with a plan. Something is happening because you are financially worse off than when you started, so something has happened. Figure out what it is, figure out a plan, be honest with your banker, and you will get a waiver and you'll move forward. Projections. I personally build the projections for our firm. And I build these fancy 5-year projections. I assure you they don't go a year before they're inaccurate. This business, things happen and change and nothing goes to plan. So if you do any projections, try to be conservative. We had a massive private equity group come into our offices, fanciest guys you've ever seen. They bring in all these laptops, they've got these spreadsheets for days, and they're trying to show us all how successful they're going to be. And our first question within the first 10 minutes was, what's the loss rate you've built into these projections? They said 4%. Prime doesn't have 4% losses. That meeting didn't last 5 more minutes before they were out on the street. Be realistic in your projections. Plan for selling 100 and hope you sell 125. Don't project you're going to sell 125 because there's seasonality, things happen. You want to make sure that your metrics work at 100, which is your minimum baseline that you're confident you can sell. And if you happen to sell 125, fantastic. But plan on, sort of a minimum number and make sure your numbers kind of work and you are at least, breaking even, if not a little bit profitable at your baseline, so that if you sell more, you should be in the money. Budgets. Not a lot of my clients have budgets, and they probably should. And the easiest way to set a budget is to, take the benchmarks as a starting point, at least a conversation starter, and we publish what the average dealer spends in advertising, in telephone, in office supplies, in outside services, legal and accounting. All those things are published as a percentage of sales. You start by comparing your numbers to benchmark, and then over time you develop your own budgets. Maybe you're in a rural market and you spend nothing on advertising, or maybe you're in a big metropolitan city and you've got to spend 4 times as much on advertising just to break into the area. That's fine. You adjust your budgets accordingly and sort of come up with numbers that you should be spending every month. And then if there's a blip against that, it's a conversation starter for you and your team to talk about what happened this month. Why do we spend an extra on this? Oh, the annual bill came due and we paid it one time. Okay, I understand. Or maybe we say, hey, maybe we should split that into 12 payments or spread that out to even out the expenses. It's just a conversation starter, but start with benchmarks, and we can get you benchmarks if you want those as your starting point, and then develop your own budgets just to keep an eye on where your cash is being spent. And I have one client. They're over 200 million in receivables and nearly 40,000 accounts. You have to requisition a light bulb. I'm not joking. I went to a store. There was 2 working light bulbs in the whole store, and I needed one of them. I had to steal it from the bathroom. They track everything, and you literally have to requisition light bulbs from headquarters. Now, that is not how I would run my business, but it's how they run their business, and they are profitable, and they track everything. They also received the largest blue sky goodwill valuation we've ever seen from private equity, purely because of their management skills. They almost received twice their asset value in purchase price, purely because of their procedures and management skills. They got paid twice what their assets, with no discount, were worth. They got paid twice that. Yeah, these are year-over-year benchmarks. They just show you, these are actual benchmarks year over year. There's some older ones, we've got the newest ones, but they just show you trends on how things are increasing. Advertising is getting more and more and more every year. People have to spend more to bring in the customer because competition's getting tighter. Payroll's pretty consistent. looks like, yeah, what's that? Rent decreased, interestingly enough. Maybe more dealers are buying their land than renting it. But anyways, if anybody needs the benchmarks, we can get them to you. Performance metrics. There are more to this business than just your financial statements. A lot more, actually. Things like your delinquency and your recency are very important. And don't take one without the other. Delinquency can be manipulated. Recency can be manipulated. You have to use them in conjunction with each other. Many of my clients, their charge-off policies say something like 60 days delinquent with no recency in 30 days. They go hand in hand, and if you aren't careful, your collectors and that can manipulate one, but it's hard to manipulate both. So you should watch both. Static pool loss rate. Static pool loss rate is what you charge off over the life of the loan. It's not CRR. It's from beginning to end, from the first dollar originated until the last dollar is collected. How much did we actually collect? So if 3 years ago you originated 100,000 in new notes in a month, when it's all said and done, if you collected 73,000 in principal, your static pool loss rate is 27%. 27% never got collected. Unfortunately, static pool is the best measure of losses. Unfortunately, it's one of those things that you need 3 years of data to know kind of where you ended up. And 3 years is a lifetime in this business. If you've been making a mistake for 3 years, that'll put you out of business before you know it. So that's why other things like CRR, which is next, and loss to liquidation and some other calculations exist to try and catch something quicker. But ultimately, the only way to really know what you collect is to figure out what you originated and ultimately how many dollars ended up in your pocket after all the loans are done. Collateral recovery rate. This is a measure of how much of the liquidation in your portfolio is coming from collections and how much is it coming from charge-offs. Like I said, it indicates things quicker than static pool, but it's not perfect because if you're in growth mode, your charge-offs don't show up for a year or two when you're in growth mode. So you might have a great CRR for the first couple of years, but that's simply because the charge-offs haven't hit yet. 2 years later, you're going to get hit with a bunch of charge-offs and ruin the CRR, and the CRR would not have seen that until those charge-offs hit. CRR is good for a stable portfolio to see if there's changes happening, but if you're in growth mode or liquidation mode, CRR loses some of its effectiveness purely because it takes a couple years before charge-offs truly hit when you jump into growth mode. And I think I'm done. Thank you, everybody.